Tonight we're going to go through Chapter 5, and the title of Chapter 5 is Capital Cost Allowance. Now, capital cost allowance is basically what we refer to as tax amortization. So whenever you hear the term capital cost allowance, that's basically what we refer to as tax amortization. Basically, it's depreciable assets, long-term assets that a company buys, and rather than take accounting amortization as a deduction, for tax purposes, they're allowed to take what we refer to as CCA, capital cost allowance. So what I want to do is just sort of go through this example together, just sort of talk about what would happen for accounting purposes, and then talk about what would happen for tax purposes. So let's sort of look at this example together. So we have this business. They buy a car on July 5th, 2024. Now remember, for accounting purposes, you get to take amortization on that car. You spread it out over its useful life. So we estimate the useful life to be 10 years for this car. And then we also have to estimate the residual or salvage value, what we think it's going to be worth at the end of the 10 years. And so the estimated salvage or residual value is $3,000. Now, for accounting purposes, there was different types of amortization methods. So we're just going to assume that this company uses straight line amortization. And what they get to do for accounting purposes is they got to figure out how much amortization they can take per year. So the cost of the car is $25,000. We minus the salvage value of $3,000. So that gives us $22,000. And we divide it by the useful life, which is 10 years. And so every year they get to take $2,200 of amortization expense per year. Whoops, what happened there? 1 second. And if you remember from your accounting classes, because we bought the asset partway through the year, we have to sort of prorate it. So for the first year, what we would do is we would take the 2,200. And because we bought it on July the 5th, if you buy it on or before the 15th, you get to take the full month of amortization. So July through December would be 6 months. And so for the first year, we would get amortization expense of $1,100. And remember, for accounting purposes, what you would show for your balance sheet on December 31st, 2024, on the balance sheet, the value of the car would be basically the original cost, 2,500 or 25,000 minus the amortization that we took. And so the value of the car on the balance sheet would be 23,900. This again was known as the net book value, or also known as the carrying value. That's sort of the value of the car that's left to still take amortization on. So that's sort of what we would do for accounting purposes. Now, for tax purposes, the way that CCA, capital cost allowance, works is when we buy these long-term assets that we're going to use in our business to help us generate income, we cannot take amortization. So we cannot deduct the 1,100. That is only allowed for accounting purposes. We cannot deduct that for tax purposes. The first thing that we have to do is when we buy these long-term depreciable assets, we have to figure out which class it goes to. And this is where we look at those CCA tables. So if I quickly just go to the CCA table that I showed you at the beginning of today's class, this is also posted on eLearn. This is all alphabetically, starting with A, B, going all the way to Z. So we're looking at automobiles, and we're going to sort of explore automobiles in a little bit more detail later. But if we look at automobiles here, we'll see that automobiles go into class 10 right over here, and it's given a CCA rate of 30%. Now we'll talk about this prescribed rate that you see here, but we'll worry about that later. But this automobile will go into class 10, and it has a 30% CCA rate. So let's sort of see what happens then in our calculations. What we would do then is we would set up this class 10. And we know that the rate is going to be 30%. And we set up this CCA schedule for class 10. Now, a CCA schedule always starts off with a balance at the beginning of the year. Now, in this case, this was the first car that the company purchased. So they didn't have anything in class 10 prior to that. So the opening balance for this class 10 is going to be 0. Now, this is sort of where we get into some challenges because the way that CCA is calculated has changed over these periods. So prior to November 21st, 2018, we used what was called the half-year rule. Between these dates, we used the accelerated investment incentive at 150%. And now in 2024, we use the accelerated investment incentive at 100%. So what I'm going to do is, for this example here, I'm going to show you how the 3 methods would differ. So I'm going to just take away the year here. I'm just going to put January 1st. And what we'll do is we'll look at all 3 methods of how this calculation would be done. So let's start with the oldest one, which is the half-year rule. So the half-year rule was basically in existence prior to November 21st, 2018. And so I'll sort of make a note here that this first column is going to be the half-year rule. So this is sort of how the half-year rule works. What we would do is we would add the cost of the car to this class. We would add 25,000 to this class, and which makes sense. That's the cost of the car. The way the half-year rule works is that in the first year, rather than have to prorate it based on when we bought it, remember for accounting purposes, we have to prorate it based on the number of months. What the half-year rule says is that because you're probably going to be buying assets throughout the year, you're going to be buying some equipment in June, some automobiles in July, maybe some machinery in January, rather than make you prorate all the additions based on how many months you own them for that first year, we're just going to let you take half of the CCA that you normally would. So the way the half-year rule worked is we would have to deduct half of the amount of the addition. So rather than take CCA on 25,000, we would take CCA on 12,500. This would be our CCA base. So we would adjust the amount we take CCA on by taking only 50% of our additions. So we take off 50% and we're left with 12,500. So then the CCA deduction, and once again, I'm just going to remove the year here, because once again, we're looking at the half-year rule, which was in effect prior to November 21st, 2018. We would take 12,500 times 30%. And so the CCA we could deduct would be 3,750. So that's 12,500 times 30%. And so the CCA we get to deduct this year is 3,750. Now what we do then is, this is sort of a continuity schedule. So we have 12,500, we minus the CCA for the year. But then remember this 12,500 that we deducted just for the calculation of CCA, we have to add it back. So we have to add back the 12,500. And then when we do the calculation of the amount that's left over, that goes forward to next year, we get 21,250, which makes sense, right? Because if you think about it, we bought the car for 25,000. This year we took 3,750 in CCA. So the balance that's left over going into next year is going to be 21,250. And so this is the half-year rule. This was in effect prior to November 21st, 2018. It basically just said that rather than make you prorate the number of months whenever you add new assets for CCA purposes, you'll just take 1/2 of the value for that first year and then base your CCA on that. So that's the half-year rule. Now, there are still some classes, very few, that still use the half-year rule, but for the majority of the classes, they sort of follow these dates here. So depending on which date you fall into, you use those rules, but there are still very limited classes that still use the half-year rule. And we'll sort of see that, I believe, in one of the later chapters where the half-year rules still exist. Once again, for a limited number of classes. So that's the half-year rule. That was in effect up until prior to November 21st, 2018. And then what happened was the rules changed. November 21st, 2018 to December 31st, 2023, we had this ACCII. That stands for the Accelerated Investment Incentive. I think I have that up here, right at the top here, Accelerated Investment Incentive. So that's what the ACCII stands for, this Accelerated Investment Incentive. So I'll show you then how the Accelerated Investment Incentive works in sort of this column here. So this would be the Accelerated Investment Incentive at 150%. And this is for November 21st, 2018 to December 31st, 2013 or 2023. We always start off with a balance. So let's say there was no cars at the beginning of the year. We had 25,000. Now, the way the Accelerated Investment Incentive works is the exact opposite of the half-year rule. Rather than deduct 50%, we're going to add 50% of the addition. So that's why it's 150% of the additions. So rather than deduct 12,500, we're going to add 12,500 when we calculate our CCA base. So our CCA base then is going to increase by 50%. We're going to take the original cost plus an additional 50%, and we get 37,500. The CCA is going to be based on 37,500 times 30%. And so the deduction that we get for this first year will now be 11,250. Now, in order to wrap up the year, once again, this is a continuity schedule. So in order to sort of wrap up the year, we're looking at these numbers here. This 50% that we added, we now have to remove it. This is the exact opposite from the half-year rule. So we take out that 12,500. At the start of the next year, our balance is going to be 13,750. Once again, that makes sense, right? Because if you think about it, we bought this car for 25,000. We deducted CCA 11,250. And so we're left with 13,750. And so once again, the way that I'm showing you how to calculate CCA, these schedules here, this is what would actually show up on a CCA schedule on an actual tax return. So if you were operating as a sole proprietorship and you bought assets to use in your business and you have to calculate how much CCA you're allowed to deduct for calculating your business income, you would actually have to complete these schedules for each class that you have assets in. This one is for class 10 because automobiles fall into class 10. And so this accelerated investment incentive at 100%, 50%, these rules are in effect for November 21st, 2018 to December 31st, 2023. Now, I'll sort of explain why the dates are significant. So prior to November 21st, 2018, we had the half-year rule that basically reduced the CCA that you could claim by 1/2, which makes sense, once again, because you buy assets partway through the year. So rather than take the full year, and rather than make you count how many months you have all these assets that you bought this year, you just get to take 1/2. So that sort of makes logical sense as to why they had this half-year rule. What happened was in 2016, as some of you may remember, that was when President Trump was elected as the US president. And one of his promises was to sort of make the US more competitive. And in doing so, he kind of changed the tax rules in the US and made the corporate tax rules in the US a lot more favorable than they were here in Canada. And so what happened was a lot of Canadian head offices decided to move their head office to the US to take advantage of those favorable US tax rules. In doing so, the Canadian government lost a lot of tax revenue because when those Canadian head offices moved to the US, they no longer had to report all their income on their Canadian tax return. So the Canadian government saw a huge sort of drop in tax revenues from these Canadian corporations. So in order to sort of stop those corporations from leaving, they introduced this accelerated investment incentive at 150%, saying that companies that buy assets will get a larger deduction in the year that they invest in these additional assets. And so this larger deduction means that they then will have more expenses that they can deduct, lower profits they have to pay tax on. And so that was sort of why these dates are significant. This was sort of one of the measures that the Canadian government introduced to once again encourage sort of Canadian companies, once again, to stay in Canada, giving them sort of larger deductions, and once again, reducing their profits that they would have to pay Canadian tax on. The accelerated investment incentive, though, at 150%, it was only slated to be in effect to the end of 2023. And so then we get to, well, what happened now in 2024? From January 1st, 2024 to December 31st, 2027, we still have the accelerated investment incentive, but it will only be at 100%. So rather than bump up by 50%, it would just be based on what the value of the new addition is. So let me just sort of show you how that would be done. So once again, we bought this car, goes into class 10. There was no cars prior, so the beginning balance at the beginning of the year is 0. We add the new addition of 25,000. We don't have to make any adjustments because everything is at 100%. So all we do then is just take CCA at 25,000 times 0.3. And so the CCA will be 7,500. So when it's the accelerated investment incentive at 100%, it just means whatever the cost of the asset is, 25,000, we'll just take CCA 30% on that 25,000, that's 7,500. So then once again, the balance going into next year will just be 25,000 minus 7,500, and we get 17,500, which again makes sense, right? Because we bought the car for 25,000, we deducted 7,500 in CCA deductions, and so we're left with 17,500 going into next year. So I wanted to sort of show you those 3 different methods because there are still a few assets that use the half-year rule, very limited. Even though in 2024, we are using accelerated investment incentive at 100%, there are some textbook problems that do multiple years of CCA calculations, and some of them start in the 2022-2023 year. So for those years, any additions would be using the accelerated investment incentive at 150%. Any questions about those 3 methods? So that's sort of what happens when there's sort of a new addition. I just want to sort of show you what happens in the following year. So let's just sort of look at this last example here. So let's say that this is January 1st, 2024. We bought the car. We do the accelerated investment incentive at 100%. And then at the beginning of next year, January 1st, 2025, our balance is 17,500. So then in 2025, the CCA for 2025 will, if we don't have any new additions, will just basically be 17,500 times 30%. And so the CCA that we get to take will be 5,250. And then the balance going into next year, January 1st, 2026, will be 12,250. Once again, that makes sense, right? 25,000 was what the cost of the car was. We took CCA of 7,500 in 2024. We took CCA of 5,250 in 2025. So going into 2026, we still have 12,250 left that we can take CCA on. This balance is known as the UCC, which stands for undepreciated capital cost. That's the amount of the original cost of the 25,000 that we have not yet taken depreciation on. That's the UCC, 12,250. Now, one thing I want to sort of mention is that these CCA amounts are the maximum. So for the first year, 7,500, that's the maximum CCA deduction. But the thing about CCA is that CCA is a discretionary deduction. And what that means is you can take 0 up to the maximum of 7,500. So if a company is losing money, they're already at a loss of income, then they may not decide to take any CCA because that would just increase the loss. So they could take 0 CCA, and if they take 0, this number would just be 0 then. And then the balance going into next year will just be 25,000 because they took 0 CCA. If they wanted to take some CCA, not the full 7,500, they could do that as well. So it's a discretionary deduction. They don't have to take it, but they can take anywhere from 0 up to the maximum calculation. Any questions about these 3 different methods? So pay attention to the questions in the textbook as to what year you're dealing with. Most of the examples maybe start with 2022, 2023. Some of them will just start right in 2024, but there are some sort of multi-year examples that are shown in your textbook. So that's why I wanted to sort of show you these different methods. So sort of keep this in mind when you're practicing some of the questions in Chapter 5. What I want to do next then is sort of talk about this concept of net additions. I kind of talked about the half-year rule, the accelerated investment incentive. And I want to sort of talk about what I mean by net additions. And to do that, we're going to go into this example here. So a business buys $20,000 in equipment in 2022. The equipment goes into Class 8, 20%. Let me show you that on the CCA rates table again. If we go quickly to the CCA rates table, once again, it's all in alphabetical order. We just scroll down to E for equipment, and we'll see at the very bottom here, equipment not specifically listed elsewhere goes into Class 8, and we get a 20% CCA rate. So we go back to our Excel document. We bought this piece of equipment in 2022 for $20,000. And let's just assume that at the beginning of 2022, there was a 0 balance. So there was no amount in Class 8. So now we got to start Class 8, and we're going to add this addition of $20,000. And once again, because we are in 2022, the accelerated investment incentive at 150% applies. So accelerated investment incentive at 150%. So that basically means we have to bump this up by an additional 50%, which is 10,000. And so this is going to give us a CCA base of 30,000. So we're going to use 30,000 as our base to calculate CCA. The CCA will be at 20% times 30,000. And so the deduction that we get to take will be $6,000. And once again, this is a continuity schedule. So then we've got to basically reverse the accelerated investment incentive amount. So that 10,000 that we added just for CCA purposes calculation, we've got to take that out now. And then the balance going into next year will be 14,000. And once again, that makes sense, right? Because we bought this piece of equipment for 20,000. We took CCA of 6,000. And so the balance going into next year is going to be 14,000. Once again, CCA, this amount here, is a discretionary deduction. Meaning, again, we could take anywhere from 0 up to the maximum. And so this is what businesses have to do. If you're running a sole proprietorship, you're running a corporation, you buy these long-term assets. For accounting purposes, you normally take amortization. For tax purposes, you've got to complete these CCA schedules for each class in which you have assets. And then you got to determine how much CCA you can deduct when you're calculating your business income. So let's go into 2023. Let's say in 2023, that piece of equipment that we bought last year, we sold for 15,000. So the equipment that we bought last year for 20,000, the next year we decided to sell it for 15,000. And then we bought a new piece of equipment for 28,000. So that old equipment just wasn't meeting our needs. We sold it. Of course, we couldn't get the 20,000 for it because we used it as used equipment. So we got it for 15,000. Whenever you sell an asset for CCA purposes, you've got to remove that asset from the class. But the amount that you take off is going to be the lesser of two amounts. We deduct the lesser of the cost. The cost of this piece of equipment was 20,000, or the proceeds, and we got 15,000 for it. Now, I'm going to go through some more detailed examples later on, explaining why we deduct the lesser of cost or proceeds. But just sort of bear with me for now. The lesser of the two amounts is going to be 15,000. So we have to deduct 15,000. And then the new equipment that we bought cost 28,000. We have this concept now called the net additions. The net additions are basically the additions minus the dispositions. So the net additions, actually I'll move this over here, is going to be 28,000 minus 15,000. So that's how we get 13,000, is we take the new equipment, the 28,000, minus the equipment that was sold, the lesser of cost or proceeds. We deduct the proceeds, that's the lesser of the two. And so the net additions are 13,000. The accelerated investment incentive, we're in 2023, so the 150% still applies. Only applies to the net additions. So it's only going to be 50% of the net additions. So rather than add 50% of 28,000, which is the new equipment, it's only going to be 50% of the net additions, which is 13,000. So we're only going to add 6,500 for the calculation this year. So then what is our CCA base? So if we think about our CCA base, we started with 14,000. We add the net additions of 13. That 13 includes what we sold plus what we bought. We add the accelerated investment incentive. We bump it up, but only 50% of the 13,000. So the CCA base then is going to be 33,500. What we will then do is take CCA of, what was it, 20%. This is class 8. So 20% of 33.5 is going to be 6,700. And then remember that adjustment that we made above for that 50%, 6,500. We have to remove that because this adjustment was only done to calculate our CCA. And then the balance going into next year is going to be 20,300. So I wanted to just sort of show you that whenever we have the half-year rule or the accelerated investment incentive, it only applies to what we refer to as the net additions. And I did sort of put that wording up here as well. It only applies to the net additions. But I wanted to sort of go through this more simple example first, where we didn't have any dispositions, and then sort of show you what I mean by this concept of net additions. Any questions about this example? If the net additions are negative, meaning that there's a greater amount of dispositions versus additions, then there would be no adjustment. If net additions are negative, then there are no net additions because you're not adding anything. So if, let's say, we just sold this piece of equipment for 15,000, but the new piece of equipment we bought was only 10,000, we would have no net additions because we would have a negative amount. We would still have to subtract that before we calculate CCA. Actually, let me just sort of show you an example of that. Let's use this same example here. So let me just copy. Let's go way over here. So we're using the same example, but what's going to happen in 2023 is that, let's say we sell the old equipment for 19,000 now. And then let's say we buy new equipment for 10,000. So just to recap, in 2022, we bought this new piece of equipment. It goes into class 8. In 2022, the accelerated investment incentive at 100%, 150% applied. So we bumped up the CCA by an extra 50% of the cost. We used 30,000 to calculate our CCA. At the beginning of 2023, our balance is 14,000. That's the 20,000 cost of the equipment we bought minus the 6,000 CCA. And then we move into 2023. In 2023, that equipment that we bought last year, we decided to sell it. So whenever you sell an asset that you've taken CCA on, you have to deduct the lesser of two amounts from the CCA class. The first is the cost, which is 20,000. The second is the proceeds, which is 19,000. In this example, the proceeds is the lesser, so that's going to be a deduction of 19,000. But then we bought new equipment. We bought new equipment for 10,000, so we're going to add the 10,000. But now our net additions is actually negative. And so we actually don't have net additions because we're not adding anything, we're actually subtracting 9,000. So in this example then, our CCA base is going to be the 14,000 minus the 9,000, which is 5,000. And so our CCA deduction for 20% will only be 20% of 5,000. That's going to be $1,000. So then the UCC going into 2024 is going to be $4,000. So if you have a negative amount for the net additions, then there's no adjustment that you have to make because there are no net additions. And once again, there's a lot of good problems for Chapter 5. Once again, the self-study problems, the textbook exercises. This is one chapter which is really, really important. It will be quite prevalent on the second midterm. And those of you that are planning to take the advanced corporate tax class, the expectation is that you will sort of fully understand all these CCA calculations going into the advanced corporate tax class, BFIN 451, if you were to take it in the next academic year. So make sure that you do sort of spend time. Next week is the reading break. So if you have some extra time, make sure that you spend the time going through as much practice for Chapter 5 as you can. Any questions before we look at some specific examples of CCA classes? So what we've done so far is sort of the normal calculations. What we're going to move into next are some exceptions. One of those exceptions is class 10.1. And what I want to sort of show you on our CCA rates table is class 10.1 relates to automobiles. So we go back to the top here, A. We'll see that, oh, hold on a second. We'll see that automobiles are sort of all, oh, hold on. They're sort of all listed here. Well, that's not good. Automobiles, as you can see, are sort of all listed here. And you'll see that there's sort of class 10 is the capital cost is less than or equal to a prescribed amount. The prescribed amount is given here. It's $36,000 in 2023, and then right below that, it's $37,000 in 2024. So what the government did was they sort of set this prescribed amount for automobiles. And they're trying to discourage businesses from buying expensive automobiles to use in their business. So this prescribed amount is set by the government. 2023 was 36,000, 2024 was 37,000. If you buy a car that's less than or equal to the prescribed amount, it just goes into class 10 and you get 30% CCA. If you buy a car that's greater than the prescribed amount, it's going to go into class 10.1. But different from class 10, where if you buy multiple cars year after year and they're less than the prescribed amount, they all go into the same class 10. But if you buy a car that's greater than the prescribed amount, then it goes into a class 10.1, and it's just that one car that's in that class 10.1. If you buy another car greater than the prescribed amount, you put that in a separate class 10.1. It does not get added to the class 10.1 that was for the first car that you bought above the prescribed amount. And there's certain rules with how we treat cars that are in class 10.1. And I want to just sort of show you using the example on the on the Excel handout. So on the Excel handout, we're going to look at assignment problem 5.2. And if we scroll over here, this is assignment problem 5.2. Oh, where's the rest of the question here? Here. So this is sort of a question with a lot of different classes. But once again, we're just going to focus first on class 10.1. And at the beginning of 2024, Carlson Manufacturing had the following UCC balances. One of those balances was for class 10.1, and the balance is 19,800. First, you have 19,800. If we look at the additional information, class 10.1, item number 4, the property in class 10.1 was a $462,000 Bentley used by the CEO The vehicle was sold in 2024 for $283,000. Now, we're given the balance in class 10.1 at the beginning of 2024 of 19,800. And so that's sort of the starting point right here. So the starting point down here, 19,800, is sort of where we are starting with. One second, for some reason my pen is not working now. Figure that out later. So I want to just sort of figure out, how do we get to 19,800? And this is, once again, where those prescribed amounts come into play. So remember, we talked about the prescribed amounts, and we said that the prescribed amounts are listed here: 36,000 in 2023, 37,000 in 2024. So I want to just sort of explain how we got to this. One second. How we got to this 19,800 is not required in the question, but I'm just going to make some assumptions here. So we're going to assume that the Bentley was purchased in 2023 and it was for 462,000. And once again, this is greater than the prescribed amount, which in 2023 was 36,000. So we know that this is going to go into class 10.1. In class 10.1, you've got to put each car over the prescribed amount in its own separate class 10.1. So there's no other assets in this class but this Bentley that was bought in 2023. So the balance at the beginning would be 0. And then this is sort of where the prescribed amount comes into play. Even though we bought the car for 462,000, the amount we add to class 10.1 is the prescribed amount. So we only get to add 36,000. So basically the rest is lost. And so this is the government's way of trying to encourage businesses to buy less expensive cars to use in their business. Even though they bought it for 462,000, only 36,000 is added to the CCA class. The rest is basically lost. They will never get any deductions for the amount over 36,000. Because this is in 2023, the accelerated investment incentive at 150% still applies. And so we've got to add 50%, which is an additional 18,000. And so the CCA base will be 54,000. The CCA deduction at 30% will be 30% of 54,000. So that's going to be 16,200. And then we've got to reverse that accelerated investment incentive that we made above of the 18,000. And that's how we would get to the beginning balance for 2024 of 19,800. So we have our CCA base of 54,000. We minus our CCA of 16,200. We reverse the accelerated investment incentive of 18,000. And the balance going into next year is 19,800. So I just wanted to sort of show you how we got to that starting point for 2024. Any questions about those calculations? Now, I put down here, if the car was not sold, this is what would happen. If the car was not sold, you would just take 19,800 times 30%. You could deduct CCA of 5,940 for the current year. if the car was not sold. But because the car was sold, this is what we have to do. Rather than deduct the lesser of cost or proceeds, when you sell a class 10.1 car in the year of disposition, there's no terminal loss or recapture. We're going to go through those terms later on, but none of that exists. Instead, you just get to claim 1/2 of the regular CCA. So the regular CCA would have been 5,940. So all we get to do is just basically take half of that, 5,940 times 0.5. And so we get to deduct 2,970. And then because there's only the one asset in this class 10.1, this class will just reset to nil at the end of the year, and then it will just be closed off. So that's class 10.1. The government tries to discourage companies, businesses from buying cars that are more than the prescribed amount. If you do buy a car more than the prescribed amount, you only get to add whatever that prescribed amount is into class 10.1. That amount over that will be lost. And then the year that you sell the car, rather than deduct the lesser of costs or proceeds, you just get to take 1/2 of whatever that CCA would have been if you did not sell that car. Now, obviously, this does not add to zero, but because it's only the one asset in this class 10.1, it would just reset to zero, and then this class would just be closed off. So I just wanted to sort of show you some of these exceptions that don't follow the general rules. Any questions about this class 10.1 example? We're going to stay with assignment problem 5.2, but now we're going to look at class 13. So class 13, if we look here, class 13, the balance at the beginning of the year is 102,000. We look at item number 5 here. The January 1, 2024 UCC balance in class 13 reflects leasehold improvements that were made in 2022, the year in which the lease commenced. These improvements were made on a property leased as office space for the company's executives. The basic lease term is 8 years with an option to renew for a period of 2. Additional leasehold improvements costing $52,000 were made in 2024. Class 13 is another exception. If you were to look at the rates table, the CCA rates table, and you were to look under leasehold improvements, so let's look under L for leasehold improvements. We see that right here. Leasehold improvements, class 13, it says straight line. So that's not really that helpful when it just says straight line. And so even though the CCA rates table does give us sort of a nice summary of all the sort of major types of assets and the class and rate they go on, the table doesn't always give us the necessary formulas. So I'm going to go back to the Excel document and show you how we deal with class 13. I put it, where am I here? Just give me 1 second. So class 13, there's a formula on page 271. So formula on page 271, just sort of highlight that here. I thought I put it here, but I don't see it here. I did type the formula out. The way the formula works is that whenever there is a leasehold improvement, you take the lesser of 1/5 of the capital cost, or 1 over the lease term remaining plus the renewal period. So this is the formula here. I'll just sort of highlight it in a different color, just so that you can sort of see the formula here. So that's the formula there, just highlighted in a different color. Now, what is a leasehold improvement? So if this company was to, let's say, lease their corporate head offices, uh, and before they decided to move in, they had to do a major renovation of the office space, that cost would be considered a leasehold improvement. And so once again, because you're doing this major renovation to this office space that you're leasing, you don't own the building, but you're paying for all these major renovations. They're going to last a long time because you're going to be in this office space for maybe 15, 20 years. That amount is called the leasehold improvement. For accounting purposes, you take amortization. For tax purposes, you take CCA. And the calculation is this formula here, the lesser of 1/5, which is 20%, or 1 over the lease term remaining plus 1 renewal period. So the 102,000, the beginning amount, was from a 2022 edition. So we know that we would have taken CCA in 2022 and also 2023 in order to get to this 102,000. So let me just sort of show you what I mean by that. Yeah, get rid of these here. So we know that in 2022, leasehold improvements were made, but we don't know what that amount is. So we don't know what that amount is. And then we know that we deducted CCA in 2022. And then we also deducted CCA in 2023. But once again, we don't know what those amounts are. And then we know that at the beginning of 2024, we're left with 102,000. And we also know that this year, we have this new addition of 52,000. Whenever you're dealing with class 13, you've always got to calculate the CCA separately for every new addition. And so I sort of made this sort of comment at the top here. Whenever there's sort of a new addition, you've got to sort of calculate the CCA separately, because it's always going to be the lesser of 1/5 or 1 over the lease term remaining plus the renewal period. So what I want to do then is focus on what the CCA will be for this new addition of 52,000. So I have that down here. So this 2024 edition of 52,000, the CCA is going to be the lesser of 1/5 of the 52,000, which is, so 1/5 of 52,000 is going to be 10,400, or, oh, 1 second, 1 over the lease term remaining plus 1 renewal period times 52,000. So let's just sort of figure out what this will be. The lease term remaining, we've got to go back to the details of the lease. So we go back to the question. The lease was started in 2022. At that time, there was 8 years and an option to renew for 2 years. We are now in 2024. So in 2024, how many years are remaining? It started at 8. 2 years have passed. We are now down to 6. But we also have to add the first renewal option, which is 2 years. So 6 plus 2 is 8. So if we go back to the 2024 edition, the lease term remaining is 6 years plus the renewal option. The renewal option gives us the option to renew for 2 years. So what we're going to end up with is 1 over 8 times 52,000. And so that's going to be 6,500. So class 13 leasehold improvements, the lesser of 1/5 times the amount of the addition, 10,400, or 1 over the lease term remaining, which is 6, plus the first renewal period, which is 2. So that would be 1 over 8 times 52,000, and we get 6,500. And so that's sort of what it meant by straight line. If you remember from the CCA rates table, it said this is straight line, meaning that we take the same amount every year. So for 2024, we would take 6,500. For 2025, we would take 6,500. And we would do that for every year, 2026, 2027, 2028, 2029, 2030. And then 2031 would be year 8. So year 8 would be 2031. And so all we would do is just take 6,500 every year. And that would give us our total of 52,000. That's what it means by straight line. Straight line, you just basically the same amount every year. And once again, because we're in 2024, we are using the accelerated investment incentive, but at 100%. So we don't have to make any adjustments. We don't have to add 50%. We don't have to deduct 50%. It's just going to be a straight line, 52,000 divided by 8. So for our CCA continuity schedule, we started off with 102. We're going to add 52,000, the new addition. And then the CCA we're going to take this year on the 2024 edition will be 6,500. So that's the CCA we're going to deduct on the addition of 52,000 that we made this year. We still got to figure out the CCA on the improvement we made in 2022, but that's going to be a little bit more of a complex calculation. Any questions about the 6,500 CCA calculation? So this is sort of where things get a little bit more complex. We know that the improvement was made in 2022. And we would have deducted an amount in 2022. We would have deducted an amount in 2023. And at the beginning of 2024, we're left with 102,000. The reason that this is a little bit more complicated is that we're not told what the original cost was. If we go back to the question, nowhere does it tell us what the original cost of those 2022 improvements were. And we also know that in 2022, the accelerated investment incentive at 150% was in place. So this is sort of where we got to use a little bit of math. So let's just sort of look at this here. In 2022, when we were calculating the CCA, we would have taken the lesser of 1/5 or 1 over the lease term remaining plus 1 renewal period. In 2022, that would have been 1 over the lease term was 8 plus the renewal period was 2. So this would have been 1/10. And that would have basically been 10% per year times the cost of the leasehold improvement. And so 1/5 is 20%, 1/10 is 10%. So obviously 1/10 or 10% is the lesser of the two. But once again, the only thing that kind of complicates the calculation is we can't just take 10% a year because of the accelerated investment incentive. The accelerated investment incentive in 2022 was an additional 50%. So we know that in 2022, rather than taking 10%, we would have taken 15% because we added an extra 50%. So 10% times 1.5, we would have deducted 15% of the cost. But every year thereafter, we're going to be deducting 10%. So if we started off with 100%, we deducted 15% of the cost in 2022, 10% of the cost in 2023. At the beginning of 2024, we're left with 75% of the cost. And we know that at the beginning of 2024, the UCC was 102,000. So that 102,000 is equal to 75% of the cost. So we can just sort of work through the math now. The cost is what we're trying to figure out. If we multiply that by 75%, we would get 102,000. So all we have to do is just rearrange the formula to figure out the cost. We're just going to take 102,000, divide it by 75%, and the cost would be 136,000. That was the original cost in 2022 when we made those leasehold improvements. And what we can do is see if that in fact was right. So if we go back to our formula here, the lesser of 1/5 or 1/10. And so the lesser would have been 1/10 times the original cost, 136,000. And so that would be 13,600 per year over 10 years. The first year, though, 2022, we would have taken 1.5 times that, right? Because in the first year, we have the accelerated investment incentive at 150%. So 1.5 times 13,600 is 20,400. So 13,600 times 1.5, 20,000, sorry, yeah, 20,400. But then every year thereafter, we would deduct 13,600. This is going to be over 10 years. So let's just sort of, this will take us all the way to 2031, 2023, 2024, 2025, 26, 27, 28, 2029, 2030, 2031. So those are our 10 years. And this is sort of where, once again, a straight line. So it's going to be 13,600 every year. But once again, the total CCA over the 10 years must equal 136,000. So in this very last year, because we took an extra 50% in the first year, this will be the remaining 50% in the last year. So rather than 13,600, this will only be 6,800. And if I just sort of quickly add up this column here, we should get 136,000. So that's a little bit more complex, but we have all the tools to figure out what the CCA was for the first 2 years. And so we know that for every year thereafter, it's straight line 13,600, except for the very last year, which will take the remaining 50%, which is 6,800. Any questions about this calculation? So what that means is that if we go back to our class 13 CCA schedule, we're going to take 13,600 of CCA on that 2022 improvement. So the total CCA will be 13,600 plus 6,500, which is 20,100. So that's going to be the total CCA. So the total CCA will be 20,100. The balance of this class going into next year is going to be 133,900. And provided there's no changes, provided we don't add any more leasehold improvements, everything is straight line. So in 2025, 13,600, 6,500, another 20,100, and then the balance going into 2026 will be 113,800. So class 13, again, is one of those exceptions to sort of the standard calculations, it uses what we call straight line, but it's based on this formula, the lesser of 1/5 or 1 over the lease term remaining plus 1 renewal period. We're going to move on to another exception to those standard calculations, and that is on class 14. So class 14 is for limited life intangibles. And so if you remember from your accounting classes, intangibles are things such as maybe franchise fees, copyrights, patents, but this is limited life. This is not goodwill. Goodwill will go into a separate class. So these are, once again, patents, copyrights, franchises that have a limited life. Now, once again, if we go to our CCA rates table, and let's just sort of look up franchises. So at the top here, franchises, limited life, we're going to class 14, straight line. Unlimited life, we're going to class 14.1, 5%. So we're focusing on limited life intangibles, and they go into class 14. And once again, we see the term straight line. Licenses, we look at licenses down here. Also, if it's limited life, class 14. Licenses that have unlimited life, class 14.1. So we're dealing with limited life intangibles, which go into class 14. And once again, it is straight line. The way that these work is that we base it over whatever their legal life is. So let's look at this example here. Let's say that we bought a limited life franchise of $375,000 on April 1st, 2024. And let's say that that franchise has a 10-year legal life. What we do then is we take the 375 and we divide it by the 10-year legal life. And so that means we're going to deduct CCA of $37,500 per year. The other thing that class 14 does is it has this rule that the CCA has to be deducted on a pro rata per diem basis. What that means is just you have to sort of prorate it per day. So because this is the first year that we bought the franchise, we have to prorate it based on the days that we were using the franchise, which is April 1st to December 31st, which is 275 days. So what that means is that we will add the 37,000 or sort of 375,000 to this class 14. Actually, we don't need this CCA base here. We don't need this here as well. So we just sort of get rid of that. So we did confirm that it was 37,500 per year, but because we have to prorate it for the first year, the CCA deduction for the first year is going to be 37,500 times 275 over 365 days. And so we work through that calculation. We should get a CCA deduction of 28,253. Let me just double check that. Yeah, 28,253. And then the balance going into next year will be 346,747. Now, once again, this is straight lines. So next year we will take the full 37,500. And once again, the balance going into 2026. So the balance going into 2026 will be 309,247. So once again, class 14 is another one of those exceptions. It is straight line. It's basically the cost divided by the legal life. And then also, if it's not used in that first year for the full year, we have to prorate it based on the number of days. Any questions about class 14? Another rule talks about short fiscal period. A short fiscal period is usually going to be either the first year or the last year where they don't have a full fiscal year. And so whenever there's a short fiscal period, the CCA also has to be prorated for that short fiscal period. So let's look at this example here. This new business starts on September the 1st. So their year end is December 31st. So normally their fiscal year goes from January 1st to December 31st, but they have a short fiscal year because it's their first year of business of only September 1st to December 31st. On October the 1st, they bought some new equipment for $10,000. And then we got to figure out how much CCA can they deduct for 2024. So that new equipment is going to go into class 8, 20%. And once again, the brand new business, so there's nothing in class 8 to start the year with. We're going to add the 10,000. And once again, we can get rid of the CCA base here, get rid of this line here. And the way that we calculate the CCA, I'm just going to get rid of these lines here. Normally, we would just take the 10,000 times the 20%, and that would give us 2,000. But now we have to prorate it because we have a short fiscal year. And this is sort of where students often make mistakes. It's not from when you bought the equipment, it's from when the short fiscal year started. So the short fiscal year started on September the 1st, September the 1st to December 31st. We're going to add the number of days. That's going to be 122 days. So the calculation will be 10,000 times 20%, which is 2,000, times the number of days in that fiscal year, which is 122 days, divided by 365. So if we work through that calculation, 2,000 would have been the CCA we normally could take, but because we have a short fiscal year, we've got to multiply that by 122 days divided by 365. So the CCA we get to deduct will be $668. And so then the balance going into next year will be 9,332. 9,000? Yeah, 9,332. And once again, CCA is a discretionary deduction. I just want to sort of show you then what would happen in the following year. So in the following year, 9,332 times 20%, and we would get maximum CCA of $1,866. They can take anywhere from 0 to the maximum. So if they wanted to, they could take $1,000 rather than the maximum, and then the balance going into 2026 would be 8,332. So once again, CCA is discretionary. Let me just put that here. And so you can take anywhere from 0 up to the maximum. If they only wanted to take $1,000 deduction because they had, let's say, less income, they could do that as well. Any questions about the calculations so far? What we'll do then is 7:15. Why don't we take a break now, and then we'll be back at 7:25 p.m. Any questions before we stop for a break? No questions? Okay, I'll see you back here in just under 10 minutes. What we're going to do next then is we're going to look at this example here, and we're going to go through the terms and explain what is recapture, what is terminal loss. So let's just sort of talk about this example. So we're looking at class 8. At the beginning of the year, the class 8 balance is $36,864. These were two assets that were bought many years ago with the original cost of each asset of $50,000. So there's two assets that were bought many years ago. Each asset had a cost of $50,000. So the total cost of both was $100,000. So we don't really worry about, when they were bought. All we're saying is that in this class 8, years ago, we added 100,000 to this class, which was two assets times 50,000 each. And then over the years, we deducted CCA of 63,136. And now we get to the beginning of 2024, and we're left with 36,864. So this is the starting point for this example. In this first column here, in 2024, we sell one of the assets for 40,000. And remember we said that whenever we sell an asset, we have to deduct the lesser of cost or proceeds. So cost of the one asset that we sold was 50, proceeds was 40. So the lesser is going to be 40. We subtract that from the 36,864. And we're left with a negative balance of 3,136. If it remains negative at the end of the year, let's say we don't add any more assets to the class, hold on. Let's say we don't add any more assets to the class and it just remains negative at year end. We cannot have a negative balance. We basically have to reset this to 0. And the way we do that is we add 3,136 to this class. That is known as recapture, and this addition will increase our business income. So whenever we dispose of an asset, we deduct the lesser of cost or proceeds. In this example, we're deducting proceeds of 40,000. This is going to result in a negative balance. Now, the only way it could get to a positive amount before the end of the year is if we added a new asset to this class 8. But let's say we did not buy any new assets, so it remained negative at year end. We cannot have a negative balance. So in order to get rid of it, we have to add 3,136, and that addition will increase our income. Rather than deducting CCA, we are going to add 3,136 to our income to bring this balance to 0. So then what is this recapture? The recapture is this negative amount that we have to eliminate by adding that same amount to our income to bring the balance to 0. So why do we have to add this negative amount to income? And this is sort of where I'm going to explain why using an economic analysis. So let's think about our cash flows. When we bought the two assets, how much money did we spend? We spent $100,000. That's negative, that's cash going out. Over the years, we took CCA. Over the years, we took CCA of 63,136. Now, CCA reduces our income, therefore we pay less tax. That's a good thing. So we're going to put that as a positive amount, positive cash flow, because that's going to basically reduce our income. So we pay less tax. So that's a positive amount for us. When the assets were sold, when the one asset was sold, we received 40,000. So once again, that is a positive amount for us. And so now if we figure out whether economically we are ahead or behind, we are now ahead by 3,136. And so that is the amount of the recapture. The recapture basically represents too much CCA that we took. We sold the one asset for 40,000. So that put us in this negative position. That means we basically are ahead. We took too much CCA over the years. And so we were ahead by 3,136 economically. So the government says, well, we don't want you to be ahead. We're going to bring you back to neutral. The way we're going to bring you back to neutral is we're going to make you add that amount to income. And when you add that amount to income, you're going to pay more tax. So economically, that's not good. And so that's just going to bring you back to a neutral position. So that's sort of an economic analysis of why we have this recapture. We bought these two assets for 100,000. So we paid 100,000. We put that as a negative. Over the years, we deducted all this CCA. That's a positive amount for us because that reduced our income. We paid less tax. When we sold that one asset, we also received 40,000 in cash. So economically, we are now ahead by 3,136. And the government says, all we want to do is bring you back to neutral. So the only way to bring you back to neutral is to make you bring that amount into income, pay tax on it. So that's not a good thing. So we put that as a negative amount. And now you're back to a neutral position. So whenever you have a negative balance in the CCA class at the end of the year, that amount is known as recapture. In order to eliminate it, you have to add that amount to your income and reset the class balance to 0. Any questions about the recapture analysis? We're going to look at another scenario using the same starting point. But this time, we're going to sell one of the assets for 60,000. We deduct the lesser of cost or proceeds. This example, the lesser is going to be cost, which is 50,000. And so now we have even a larger recapture of 13,136. In order to bring it down to 0, we have to add this amount to our income, 13,136, and that will reset this to 0. So on the CCA schedule, when you fill out your tax return, this is sort of what you'll show. And then this amount on your statement of business income, you would add 13,136 of income to your business income for the year. And once again, that would increase your income, therefore you pay more tax on it. Whenever you sell an asset though, you've always got to be aware of, did you sell it for more than the cost? So remember here we deducted the lesser of cost or proceeds. The lesser was cost. We sold it for 60,000. So if you sell an asset for more than the cost, you're also going to have a taxable capital gain. 50% times what you sold it for minus the cost. So your capital gain is 10,000, but your taxable capital gain is 5,000. And so this 5,000 would be added to 3B when you're calculating your net income for tax purposes. So in this example, if this was, let's say, a sole proprietorship, they would add 13,136 as recapture to their business income. And then they would also have a taxable capital gain of 5,000 as well, because they sold that asset for more than the original cost. Once again, which doesn't really happen a lot when it comes to depreciable assets, because depreciable assets usually go down in value. But I just wanted to sort of show you that it's possible that there could be a gain as well if it's sold for more than the original cost. So now we know what recapture is. What about the term terminal loss? Let's go to the third scenario here. In this third scenario, now we are going to sell both assets, so both of them, for 20,000. So this is sort of more realistic because usually assets will go down in value quite drastically, especially if we use them for a number of years. So because we're selling both, we deduct the lesser of the total cost, 50,000 each. So total cost is 100,000. We sold both for 20,000. So the lesser is going to be 20,000. So we deduct 20,000. And we're left with a positive balance of 16,864. Now, because there are no assets remaining, so remember, there's no assets remaining here, we have to then close this off to zero at the end of the year because there's no assets remaining. The only way to get that to zero is we now get a deduction of 16,864. This is known as a terminal loss. So when you have a positive balance and there's no assets remaining at the end of the year, that is known as a terminal loss. In order to get that account balance, that CCA class balance down to zero, you now get a further deduction of 16,864. You're not taking CCA because there's no assets left. So you get this deduction of 16,864 when you're calculating your business income. Now, I want to sort of explain again economically why that makes sense. So we bought the two assets many years ago, 50,000 each. We paid 100,000. Over the years, we got to deduct CCA of 63,136. So we'll put that as a positive amount because that's going to reduce our income. We pay less taxes. When we sold the two assets, we received 20,000 in total. So economically, let's figure out, are we ahead or are we behind? So right now, we are behind by 16,864. That is our terminal loss amount. Because we are behind, the government says, well, we want to bring you back to a neutral position. So we're going to give you this additional deduction of 16,864. This additional deduction will reduce your income. So that's a positive amount to you. And that will bring you back to a neutral position economically. And the reason I'm showing you this economic analysis is that if you're working as an accountant, let's say in public practice for an accounting firm, you're going to be doing all these calculations for your clients. They're going to see this recapture amount that they have to add to income, and they're going to be really upset. Why do I have to add this recapture to income? I don't understand. But if you explain it to them economically, why that is, then they still won't be happy about adding this amount to income, but at least they'll understand why they have to add this amount to income. And that sort of ties to something I've probably said in the past, is that it's good to sort of understand all these rules, but when you start working in the professional world, whether it be as an accountant or a financial planner, the way that you'll set yourself apart is being able to explain these more complex items to your clients in a way that they can understand, because they're not going to be accountants, they're not going to be financial planners. So if you're able to explain these concepts to them in a way that they can understand in just sort of basic terms, then that will set you apart from, your peers. So sort of keep that in mind as you're sort of moving through your last couple of years here at Capleton University, and when you enter the workforce. Always think about developing your soft skills, because those are going to be the important skills that will set you apart from your peers. Any questions about the terminal loss example? I'm going to go through one other scenario here where, let's say that instead of two assets, we had three assets to start with. And now we just sold two for 20,000. So we're going to deduct the 20,000 here, the lesser of cost or proceeds. And in this example, we're going to have the same 16,864. But in this example, because we had three assets and we only sold two, there is still one asset remaining. If there are still assets remaining, and even if we have a positive balance, we will just continue taking CCA. This is class 8, which is 20%. So we would just continue taking CCA at 20%, which is 3,373. And the balance going into next year is 13,491. So just a couple of things to keep in mind. With a terminal loss, it's a positive balance. but there are no assets remaining. If we sell some of the assets, but there are still assets remaining, we just continue taking CCA using the CCA rate. What we're going to move on to next then is class 14.1, goodwill and unlimited life intangibles. So let me just bring up again the CCA rates table quickly. So here is the CCA rates table. Let's scroll down. Let's scroll. Actually, goodwill is right here. Goodwill is right here. Goodwill class 14.1 at 5%. And then remember we talked about unlimited life intangibles. Remember this franchise up here? We said unlimited life class 14.1, also at 5%. So class 14.1 is for goodwill and unlimited life intangibles. So let's go back to our handout and have a look at this question together. Now, you probably heard about goodwill from your accounting classes, but basically goodwill is when you buy another business and you pay more for that business over the value of their net assets. Net assets is basically the assets minus the liabilities. So if the company that you're buying had assets worth 120,000 and you assume their liabilities of 20,000, then the net assets would be 100,000. And let's say you paid 110,000 for the net assets, then the extra 10,000 that you paid would be considered goodwill. Unlimited life intangibles, things such as incorporation costs, maybe customer list, those are unlimited life intangibles. You could also have unlimited life franchises as well. But anything that is considered goodwill and an intangible that has an unlimited life would go into class 14.1, which has a CCA rate of 5%. Now, I made some notes here about where this is talked about in your textbook. They kind of just chop it up into different areas of the textbook. So I kind of put these page references here. So that way, if you're wanting to read up on goodwill and class 14.1, you can just sort of go through these pages and then just sort of read these pages continuously rather than have it all chopped up, which may not be as easy to remember. But one thing to sort of keep in mind is that all amounts are added to a single class 14.1. Even if you were to buy multiple businesses over the years and you pay goodwill, it would all go into a single class 14.1. The only time you would have a separate class 14.1 if you were to buy a business and pay goodwill is if that business was going to be continued and operated separately. So we're going to go through an example where the company buys businesses, pays goodwill, but it's incorporated into their operations. So it's all going to go into class 14.1. And then we're going to look at an example where they buy a business and they pay goodwill, but they're going to operate that business separately. It's still going to be their business, but they're just going to operate it separately, separate sort of management. And in that case, you would put that goodwill in a separate class 14.1. Another thing to note here, every business is deemed to have goodwill. And so what that means is that every business is deemed to have some goodwill, even if it's not on their financial statements. So because every business is deemed to have goodwill at any point in time, there will always be assets in class 14.1. Remember we talked about terminal losses, and we said a terminal loss is if you have a positive balance, but there's no assets remaining. With class 14.1, because of this rule that says all businesses will always have some amount of goodwill, even if they've never bought another business, there's some goodwill that they internally generated. They're always going to have goodwill in class 14.1. So there will never be a terminal loss until the business actually stops operating. So if the business was to stop operating, they sell all their assets, then if there's an amount in class 14.1, then it would be considered a terminal loss. But if there's a balance in class 14.1, and let's say they sold their unlimited life intangibles, there would not be a terminal loss. They would just continue taking CCA at 5% every year. And so I wanted to sort of go through class 14.1 in a little bit more detail because it's probably one of the more complex classes in dealing with CCA. So why don't we take a look at assignment problem 5.6. There's a number of cases here. We're just going to work through case 1 first. So let's look at assignment problem 5.6. So Yelton is a public corporation. They have a calendar year, and at the beginning of the year, the class 14.1 balance is 0. Their policy is to deduct maximum CCA every year, and we have these 5 independent cases relating to class 14.1. So let's look at case 1. In 2024, Yelton buys another business. They pay $176,000 for goodwill. That business is integrated into their main business. So that means they're not operating it separately. And they also buy an unlimited life franchise in the same year for 2024. So let's just deal with 2024 first, and then we'll look at 2025. So for case 1, we have 2 additions. We have the goodwill, and we also have the unlimited life franchise. Let's look at our class 14.1. The balance at the beginning is 0. We're going to add our goodwill. So the goodwill is 176. The unlimited life franchise is 224. So the net additions will basically be, I think that's 400,000, right? Oh. Yeah, 400,000. Once again, don't worry about the CCA base, because remember, we're in 2024. So the accelerated investment incentive will be at 100%. So we don't have to make any adjustments. We're just basically going to take 5% of the 400,000. And so the CCA for the first year will be 20,000. And then the UCC going into next year going to be 380,000. So once again, fairly straightforward. Once again, we're in 2024. So the accelerated investment incentive is at 100%. So we don't have to make any adjustments to our net additions. Let's see what happens in 2025. In 2025, the company sells a portion of its business. So that they're now selling a portion of their business. And when they sold their business, they get a payment of $197,000 for goodwill. So goodwill is one of those intangible assets where if you buy another business, you might pay more for that business, and that extra amount is considered goodwill. You sell part of your own business, you may receive payment for goodwill as well. And so because it's an intangible asset, it's one as an asset that you cannot see, feel, or touch. So what happens then is that when we sell that goodwill in the following year, the only goodwill that we currently have, so remember the goodwill that we bought last year? So the only goodwill cost that we have in this class 14.1 is this 176,000. So even though we don't know if we sold exactly that same business that we bought last year, the cost of the goodwill currently in this class 14.1 is 176,000. So that's what we're going to use as the cost, is 176,000. The proceeds was 197. So the lesser of the two is going to be the 176. And so that's going to give us a balance of 204,000. What we're going to do then is take CCA at 5%. So 204,000 times 5%, we get a deduction of 10,200. And then the balance going into next year will be 193,800. The other thing that happens is, remember we said that whenever we sell an asset for more than the cost, there could be a capital gain. We sold and we got a payment of 197,000 for the goodwill. The only cost that we have for goodwill is 176. So we also have to report this capital gain of 197 minus 176. And so the capital gain is going to be 21,000. And then we have to multiply that by 50%. So the taxable capital gain is going to be 10,500. So this is sort of where we're sort of tracking the cost of the goodwill. The goodwill that we bought last year was 176. We sold some goodwill in 2025. And so we're going to minus the lesser of the cost of the goodwill that we had, which was 176 in the proceeds. So at this point, the cost of the goodwill is going to be 0. So we sort of have to track the goodwill cost. We bought it for 176. We deducted 176 in 2025. So at this point, we don't have any more cost of goodwill in this class 14.1. Once again, as I said earlier, every business is deemed to have some goodwill, even if it has a 0 value. And so in this example, there's no cost to the goodwill in class 14.1.
I'm just wondering, how can a business have goodwill if there is no value to it?
It's just sort of one of those things where it might be internally generated. So the business itself might have some sort of intangible qualities that sort of has internal value, maybe sort of the location, maybe their customer list. And so even though it's not anything that can be sort of identified, it probably wouldn't be sort of determined until they started selling parts of their business. If someone's willing to pay more for it, then that's sort of where the actual value of the goodwill is. But all they're saying is that with class 14.1, because the Income Tax Act deems every business to have some goodwill, even if the value is 0, you're never going to have a terminal loss in class 14.1 if you've sort of sold all the assets that were in class 14.1. That's sort of the only point that they're trying to make. But I sort of get what you're saying. Goodwill, again, is one of those things that you can't really identify. If a business is doing well because they have a good reputation, they have sort of a good location, they have a strong brand name, even though we know that there is goodwill, if they were to sell that business, a value can't be put on that until they actually sell it to a third party. So I don't know if that sort of helps with the explanation. Does that sort of help with the explanation?
Yeah, that makes a lot of sense, actually.
Okay,
Yeah.
perfect. Thank you. Any other questions about this case 1? So let's look at, we're not going to do case 2 and 3. We're just going to go to case 4, and then we're going to do case 5 as well. So case 4, Yelton buys 2 businesses. The first business, they pay goodwill of 129,000. The second business, they pay for goodwill of 114. Both of these are integrated into their main business, so we don't put them in a separate class 14.1. So let's see what happens in 2024 first for case 4. So case 4, once again, 0 balance to start off with. Goodwill of 129,000, goodwill of 114. So the net additions are going to be 243,000. Once again, can get rid of that CCA base there. the CCA at 5%. So basically it's just going to be 5% of 243. So 12,150. And so then the balance to start off next year going to be 230,850. So that calculation is fairly straightforward. Once again, we're in 2024. So the accelerated investment incentive is at 100%. So we don't have to make any adjustments to the 243,000. Then we move on to what happened in 2025 for case 4. In 2025, Yelton sells a portion of its business, and that includes the sale of goodwill for 136,000. So once again, looking at case 4, they sold part of their business, and included in that sale was a payment that they got for goodwill. And so now we got to track. Actually, let me just bring all this up here. Let's just actually track the cost of the goodwill. In 2024, they bought goodwill, or they bought 2 businesses, and the total goodwill was 243,000. So that was the total cost. So when they sell part of their business in 2025 and they get a payment for goodwill, the cost we're going to use is the total cost that they added to class 14.1 for goodwill, which is 243. The proceeds that they got for goodwill was 136. So the lesser of the two is going to be the 136. And so the updated base amount after the sale is going to be 94,850. So the CCA then will be at 5% of 94,850. So that's going to be 4,000. Let's just round it to 4,743. Going to round this. 3. And so the balance going into 2026 will be 90,107. So once again, when you're disposing of part of your business and you get a payment for goodwill, what you're going to use as the cost is the cost of all the goodwill that have been added to this account, which was 243, and then the proceeds that you got was 136. And so the lesser of the two is the 136. Now, we've got to track the updated cost of the goodwill now, because we did dispose of some goodwill. We subtracted 136 from this class 14.1. So the updated cost of the goodwill in this class is basically 107,000. So let's say in 2026, we were to sell another part of the business and we got a payment for goodwill, then the cost we would use going forward would be 107. So we've always sort of got to keep track of what is the updated cost of the goodwill that's currently in class 14.1. Any questions about case 4? So let's look at case 5. Now, case 5 is similar, but with a slight twist. So in case 5, it says, use the same information as case 4, but assume that they're going to operate the businesses separately, and that the 2024 purchases, they're going to operate those 2 businesses separately. And then we'll get to the 2025 after. But we're going to buy 2 businesses. We're going to pay goodwill, one for 129, one for 114. But we're going to operate them outside of their current business. So we've got to put those amounts in separate class 14.1s. So scenario 5 here. Oh, where are we here? Here we are, case 5. So we're going to have two separate class 14.1s. Both of them will start off with 0. So the balance at the beginning is both going to be 0. To one of the class 14.1s, we're going to add the 129,000. To the other one, we're going to add the 114,000. The CCA at 5%. And so if you look at these amounts here, 6,450, 5,700. If you add those two together, you're going to get 12,150. So it's 5,700 plus 6,450. You're going to get 12,150. That's the same as what you got here, because basically we're just separating the additions into two separate classes, but we're still multiplying each of the additions by 5%. So even though they're in separate classes, the total CCA is still going to be the same. What will change, and let's just finish off the calculation here. Let's do the balance going into next year. So now we have two separate class 14.1s. One has a balance of 122 to 550. The other one has a balance of 108,300. Then we move into 2025, what happens in the following year. So we've done the 2024, and we're going to assume that the 2025 sale for 136,000 was a result from the sale of business one. So business one was the one that we paid goodwill for 129,000. We took CCA in 2024, and now in 2025, we're going to sell that business, but we get a payment of 136,000 for goodwill from the sale of that business one. So let's go to business one. So for business one, we are now going to sell it, and included in the sale is a payment for goodwill. And the cost of the goodwill that we currently have in this class 14.1 is 129,000. The proceeds that we get for the sale of this business for the goodwill is 136,000. So the lesser is going to be the 129. We have a negative amount. And remember, we have just sold the goodwill from this class 14.1. We have a negative amount. We call this recapture. And once again, how did we deal with recapture? We have to add this to income. So we've got to add 6,450 to income. And that will just sort of reset this balance to 0. Now, the one thing that I've got to remind you is that whenever you sell a depreciable asset, in this example, goodwill, and it's sold for more than the cost, there's also going to be a taxable capital gain. So the taxable capital gain will be 50% times the difference between the proceeds, 136,000 minus 129,000. And so 50% of that will give us a taxable capital gain of 3,500. So for this first business that was sold, there would be recapture of 6,450. So they're going to have to add that to the company's income, 6,450. And then there's also going to be a taxable capital gain of 3,500 from the sale of this business one for the goodwill that they received of payment of 136,000. Now, if you notice the thing about the recapture, it equals exactly the CCA that they took last year. Because if you think about it economically, they paid 129,000 for the goodwill. They received a deduction of 6,450. But when they sold business one, they got all of the 129 back plus an additional 7,000. So that CCA that they deducted last year, they got it all back. So that's why they have to add it back to income. So hopefully that will sort of maybe reinforce why this negative amount has to be added to income. Any questions about business one? Now for business two for 2025, this is still operating. So we just continue taking CCA at 5%. And so 5,415. And so then the balance going into 2026 UCC will be 102,885. Any questions about these two calculations here? And so for business two, as long as they continue to operate it, they'll just continue taking 5% CCA every year. So these are just extra. I'm just going to erase this here, just extra things. And that was all the questions that I wanted to cover today with respect to CCA. So as I said earlier, CCA is one of these topics that is really important to master, not just for the midterm. It will be, heavily tested on midterm number 2. So make sure that with the reading break coming up, if you do have some additional time, that you do sort of go through as many of the exercises and self-study problems from the textbook that you can. Just to remind everybody, just going to bring up eLearn quickly. So next week is reading break. So as I indicated here, next week is reading break. So there's no classes next week. Our next class, we're going to go through chapter 6. The week after that, we'll go through chapter 7. In terms of the chapter 5 quiz, because of reading break, the chapter 5 quiz won't be due until Monday, February the 24th. But once again, try to get it done sooner rather than later, rather than wait till the last minute. Any questions before we wrap up? No questions. So once again, no class next week. So once again, enjoy your week off for reading break, and we'll see you back here in 2 weeks' time.